Hello, I'm Lauren Hamilton, founder of Open Books Accounting. Today I'm going to take you through a lesson I put together on reading your balance sheet and income statement, which are two of the main financial statements that we look at when we're evaluating your practice and how we can use those numbers to help you get to your goals. So, we want to think of financial statements as a story that tells the health or your financial health of your practice. So, the first statement we're going to look at is your balance sheet. And if you want to look at it or as a snapshot of your practice's finances just on a single day. So, your balance sheet is going to show you what you own, what you owe, and what's left over. And those things are highlighted on the balance sheet in three separate categories. The first one being assets. So, assets are going to be everything that you own. So that would be cash. If you have accounts receivable, which means those are the invoices that people still owe you money for. So if they haven't paid you yet for their session or product that you have, that's called accounts receivable. It could also be your office furniture. If you have leasehold improvements, so let's say you don't own your office, but you're renting it, but you had to do some like structural improvements, not really structural, but if you had to paint it or if you had to redo the flooring or you had to add a wall or anything like that, that's what we call leasehold improvements. So basically, you're just upfitting this space for you to be able to use it for your practice needs. So the next category are liabilities, and that's everything that you owe. So that would be if you have a business credit card, if you have accounts payable, which that's the opposite of accounts receivable. So accounts payable are going to be things that you owe. So if you have a utility bill or a tax bill that you know you're going to have to pay in the future, that would be in your accounts payable. So that will be a running record of everything that you need to pay at a future date. Another common liability are bank loans. So if you had to take out a loan to start up your practice, then those will be in the liability section. Our last category is equity. So that's everything that's left over if you were to sell all of your assets and paid off all of your liabilities. And that can either be a positive or negative number. And if it's positive equity, that just means that you have enough assets to cover all of your liabilities, which is good, and that's what you want to have. Negative equity just means that you can't cover all of your liabilities with your assets. So that would mean that you owe more than what you actually own, which is not good. And, we'd want to work on that. The equity will also show you just kind of the net worth of your practice. And if you are looking at getting another loan or anything or appraisals or anything like that, that's where the banks are going to look to make sure that you have enough equity in your practice to be able to do those things. So overall, this is what a balance sheet looks like, and obviously the golden rule for a balance sheet is that it has to balance. So what that means is that we have to take your assets, which are the things that you own. So like we said, your checking account, accounts receivable, office furniture, leasehold improvements. And on your fixed assets, like those office furniture and leasehold improvements, you'll have depreciation taken out because those items, will decrease in value over time. And so we account for that with accumulated depreciation. So your total assets are, going to be here after adding all of those up. The bottom half of the spreadsheet is going to, or balance sheet, is going to include your liabilities and equity. And so we said liabilities were like credit cards or loans, line of credit. So we're going to have a total of liabilities, but then we're also going to look at your equity. And I forgot to mention previously, but equity can also be the amount of funding that you put into the business. So if you put in 7,500 of your own money, like from your personal accounts into the business, that's what we call capital or contribution, depending on how your practice is set up structurally. So with that capital, we want to make sure that's listed out there. Then you can also make a distribution to yourself, or another word for it is draw. So that could be that you are taking money out of the practice. So let's say if you're a Schedule C, you can't pay yourself a salary or wages because you're not allowed to do that on a Schedule C. So that could be where you're paying yourself as a draw, or if you are an S corp, then you do have to pay yourself wages. That's one of the requirements of being an S corp. But you can also take distributions out in addition to your wages. So those would also go here as well. So with your equity, you're going to see your earnings from prior years, which is retained earnings. And then you're going to have your current year earnings, and that's from your income statement, which we'll get to next. So all together, we're going to have liabilities and equity added together, and that gives you the same balance as your assets, which is what we look for. You cannot have a balance sheet where the assets and the liabilities and equity do not match. Otherwise, it's not a balance sheet. um, so that's the main thing that you want to look for there. So our next financial statement is the income statement. And this is just like it says, we're basically just looking at a record of all of your income and expenses that are coming in and out of your practice. So that's money coming in, going out. And then we're also going to be able to take that to get what we call your net income. And net income is just income minus expenses. So on your income statement, which is what we have a example here, your income is going to come from your counseling fees, or if you do have a product, if you host webinars or retreats or group therapy sessions, anything like that where you're earning money for your practice, that goes here as your total income. Then you'll have all of your operating expenses, which can be your marketing expenses, administrative expenses like office expenses. And then your big one is continuing education, all of your classes that you're taking to stay up to date on your licenses, insurance expense, payroll if you have it, rent, travel, which is always a tricky one. Sometimes you do want to make sure that anything that is in your travel expense is business related and that there's nothing personal in there. And then utilities. You can also have, many more, but just kind of as an example, these are kind of the main ones. So what we do there is we total all of those up and subtract that from your total income, which gets you your net income of $20,000. So that's a very high level look at your balance sheet and income statement. If you still have questions about any of those, I would love to connect with you and work with you and talk through what those questions are and maybe how I can help you with your practice. You can reach me at openbooks.llc, or if you want to email me, my email is there on the screen as well. Lorin, Lorin, at openbooks.llc. Thank you.